Imagine a sprawling, pristine city built entirely on a frozen lake. Above the surface, everything appears perfectly stable, but the structures themselves are entirely dependent on the physical integrity of the ice beneath. When that underlying foundation begins to silently fracture, the architecture above collapses, regardless of how well it was built. In institutional finance, traditional discounted cash flow models operate under a specific assumption that a firm is a going concern with unconstrained, permanent access to capital markets to fund its daily operations. This diagram displays the standard DCF valuation formula alongside the weighted average cost of capital, or WACC. During a freeze in the repurchase agreement, or repo market, this mathematical model breaks down. The risk-free rate becomes highly volatile, while the historical beta and market risk premium lose their stability. Small changes in these inputs cause the WACC to spike aggressively, giving a false sense of precision while rendering the discount rate mathematically meaningless. The majority of a firm's current valuation relies on its terminal value, the projected cash flows far into the future. But if a company lacks the overnight cash to survive the next 24 hours, those future projections vanish, and the terminal value drops to exactly zero. During systemic shocks, absolute liquidity constraints override long-term fundamental asset valuations. Traditional solvency metrics lose their utility when a firm cannot monetize its assets to cover immediate operating expenses. The mechanism that controls this daily flow of cash is the repurchase agreement, or repo market. It acts as the underlying plumbing that allows the global shadow banking system to function, trading massive volumes of debt for short-term cash. Recent data indicates the gross size of the U.S. repo market reached approximately $11.9 trillion in 2024. This diagram shows the four distinct operating segments that comprise the U.S. repo architecture: tri-party, GCF, DVP brokered, and non-centrally cleared bilateral repos. The tri-party, GCF, and DVP segments are either centrally cleared or operate with moderate to high regulatory transparency. This allows for centralized tracking and more consistent oversight of capital and collateral flows. In the non-centrally cleared bilateral repo market, trades occur privately between parties like hedge funds and dealers. This segment accounts for roughly $4.6 trillion, operating with flexible terms that often bypass central oversight. This unmapped 38% of the market represents a significant blind spot for regulators, serving as a primary source of modern financial fragility. To understand this fragility, we have to look at the mechanics of a single bilateral repo transaction. Economically, a repo is a secured short-term loan. Legally, it is structured as a sale of a security with a simultaneous agreement to repurchase it at a higher price later. Passing legal title from the borrower to the lender allows the cash lender to bypass lengthy bankruptcy proceedings. They can immediately liquidate the collateral if the borrower defaults. To protect against potential drops in the collateral's market value, lenders demand a haircut. This is a percentage reduction in the value of the collateral when determining the actual cash loan amount, ensuring the transaction is over-collateralized. The haircut is determined by this equation: collateral value minus cash loaned divided by total collateral value. Treasuries are premier collateral. Nearly $594 billion operate with a 0% initial margin, reflecting their high liquidity. While zero haircuts create high systemic efficiency, they also create a vulnerability. Any perceived risk or downgrade to that collateral can force a massive system-wide increase in haircuts. Shadow banks utilize securitized banking to transform long-term, illiquid assets into seemingly safe structured bonds. By packaging residential mortgages or auto loans into asset-backed securities, they create liabilities that function as money-like instruments during normal conditions. These packaged bonds are then used as collateral in the repo market to raise the short-term cash needed to fund the shadow banking intermediation chain. Liquidity in this system is amplified by rehypothecation. A cash lender who receives collateral can immediately repledge or resell that same asset to a third party to secure their own borrowing. This diagram shows the multiplier effect. A single treasury bond moves through three financial institutions, supporting multiple financing layers. U.S. SEC rules cap rehypothecation at 140% of net liability, while non-U.S. markets use a title transfer structure for unrestricted collateral reuse. This reuse improves market efficiency, but it also introduces pro-cyclicality. The collapse of a single node in a collateral chain can prevent the return of securities, leading to a cascading failure of liquidity. Mechanically, the 2007 to 2009 financial crisis functioned as a systemic run on repo by institutional lenders. Lenders withdrew their money by demanding unprecedented increases in haircuts. Anxiety over subprime mortgage defaults triggered a breakdown in the interbank market.
Lenders responded by hiking haircuts on structured securities, which were once zero, to nearly 50% by late 2008. Across a $10 trillion repo market, a 20% average haircut creates a $2 trillion gap. The Diamond-Dybvig model explains sequential service. Creditors rapidly withdraw funding. Banks must sell collateral, driving prices lower and haircuts higher in a downward spiral. This reached its peak in September 2008 with the failure of Lehman Brothers. Relying on the repo market, it collapsed when lenders refused its collateral. The 2008 crisis demonstrated that even high-quality collateral cannot guarantee survival if the repo market plumbing itself is broken. Frictions in the plumbing can disrupt the system even without a solvency crisis. On September 17, 2019, intraday repo rates spiked to 10%, more than 300 basis points above the Federal Reserve's target range. This was caused by mundane triggers. Corporate tax deadlines hit. Money market lending pulled back, and heavy Treasury settlements forced dealers to seek increased funding. As cash vanished, repo rates spiked violently, disrupting monetary policy. This occurred as Federal Reserve normalization reduced aggregate bank reserves below $1.4 trillion. Internal constraints prevented large dealers from reallocating liquidity, leaving smaller DVP broker-dealers facing much higher rates. The 2019 episode highlighted how informational gaps and internal bank constraints can cause severe market disruptions, even when central bank reserves are otherwise abundant. Following the 2008 crisis, the Basel III reforms fundamentally reshaped how banks participate in the repo market and manage their balance sheets. The liquidity coverage ratio mandates that banks hold a sufficient stock of high-quality liquid assets to survive a significant 30-day stress scenario. This has led banks to favor cash and 0% risk-weighted sovereign debt. The net stable funding ratio promotes long-term stability by requiring banks to fund assets with stable sources over a one-year horizon. To discourage reliance on short-term wholesale funding, the rule assigns open repos with hedge funds an available stable funding factor of exactly 0%. These constraints have buffered core banks, but also led to spread dislocations. Banks now charge a premium for transactions that use up their limited regulatory capacity. The Basel III framework successfully buffered traditional core banks by redirecting high leverage activity into the unregulated shadow banking sector. To address these shifts, the Federal Reserve transitioned from LIBOR to SOFR, the Secured Overnight Financing Rate. SOFR is derived from the broad cost of borrowing cash overnight collateralized by treasuries, representing over $1 trillion in daily transactions. The Fed also created the Standing Repo Facility. This serves as a daily backstop, allowing eligible counterparties to access liquidity directly from the New York Fed to prevent 2019-style rate spikes. The New York Fed conducts these daily operations, ensuring that the primary dealers and depository institutions responsible for market stability maintain access to cash. In December 2023, the SEC adopted new rules requiring a large portion of the U.S. Treasury and repo markets to be centrally cleared. For compliance, cash secondary market transactions must be cleared by late 2026, and the repo market by June 2027. By inserting a central counterparty, the mandate standardizes margin requirements, enables dealers to net positions across trades, and provides regulators visibility into concentrated risks. While central clearing improves transparency, it introduces new costs. Higher margin requirements may impact the contracting flexibility that currently exists in the private bilateral repo segment. Despite these reforms, the Financial Stability Oversight Council has identified emerging risks from high leverage within the hedge fund sector. This risk is concentrated in the Treasury cash futures basis trade, an arbitrage strategy that relies on selling futures and buying cash treasuries. This trade is heavily dependent on stable overnight repo funding. This chart shows the scale of the exposure.
aggregate hedge fund repo borrowing reached a record $2.2 trillion in mid-2024. The exposure is highly concentrated. The 10 largest hedge funds alone account for $1.3 trillion of that borrowing. Multi-strategy pod funds are especially vulnerable. A breakdown in historical correlations could lead to multiple pods reaching their risk limit simultaneously, triggering a sharp deleveraging that could impair Treasury market functioning. The Council also warns that a reliance on a small number of AI models could create new forms of systemic risk if those models react identically to a market shock. If these synchronized models trigger a mass exit from the funding markets, the resulting liquidity famine could turn localized volatility into a systemic crisis. When the repo plumbing ceases, the immediate need for cash overrides the long-term fundamentals of any individual firm. Monitoring these highly leveraged choke points, the specific channels where assets are transformed into executable funding, provides a critical window into the system's most acute vulnerabilities.